Welcome, James.
Thank you, Godfrey.
Very good to see you after so many years, after COVID and all these other challenges.
You're getting out and about nowadays. I mean, haven't been in studio for 2.5 years.
Absolutely. We have to retrain you.
That's it. Please do.
I want to begin on the bond side today. It's an area that we rarely speak about, but each time I read the headlines and the minutes and the notes that I get from guys like yourselves and the other banks, there's one word that runs through everything: volatility. That continues to be the case. Let's just talk about where that has left valuations, in particular in the South African space.
That's a brilliant question. Thanks, Godfrey. Because volatility, if you think about it, is reduced when there's equal buyers and sellers. So market volatility often happens when a market might well be fully positioned, and it kind of feels like that in the bond market tense. You've got investors that like the value. Domestic investors like the value in bonds. The yield curve is the steepest one in emerging markets. We've got really high risk premium here. So when you compare it to other asset classes, it makes a lot of sense, especially compared to inflation, those high real returns. So investors like them and they're positioned. But we're responding to so many external market stimuli. Look at what's going on in the UK, in the US, and those bond markets. So we sell off, and it appears to be this huge vacuum because there's no marginal buying, no additional buying coming through because the market's well positioned. And I think that's what's creating the volatility. Also, it's not moving on SA fundamentals.
Yeah.
If say fundamentals, for instance, improve, or if inflation data supports it, you'd get additional buying coming through. But foreigners at the moment have reduced their holdings. We see that in the stats year to date, massive selling. And until that they return, until things improve, or until global markets require that you get into EM for that additional yield, that's the real problem, adding to our bond market volatility.
Yeah, I was also going to reference that because I remember the other day I was writing up the stats from the JSE showing foreign net and sales and purchases of South African bonds and equities. Though on the bond side, I think there still remains a plus, even after the pressure of the selling that we have seen. The other day, the governor was in New York, as well as in Washington, talking to some very smart people, and he was telling them that South African assets are very well priced. And part of the reason he was saying that was because we have tried to create credibility in our markets. Is that a view that you share in terms of the pricing of local assets in general, and then in the bonds sector in particular? I wanted to know which part of the curve you think perhaps when the money starts coming in, people should be going for.
Yeah, it's going to be the long end, you would think, but the long end offers additional risk, of course, of repayment. So the shorter the better. So you've got to look on the curve where it's the steepest to get your best value. So it kind of looks like the 15-year term to maturity area of the curve is offering the most value. But investors also like the really long end because you get sort of a higher octane return, a slightly higher yield there. But I think, the value is certainly there. I would agree with the governor. Remember also, in the back of their minds, they're thinking about a lower inflation target down the line, which makes nominal...
He keeps talking about that.
Exactly. So at some point, of course, it's interesting that he's still talking about it through this high period of inflation the world is in. So you can imagine as soon as it starts trending lower, that's going to gain momentum, making nominal bonds a really attractive buy.
Yeah, some of us will be squealing all along the way while he's saying let's go to that 4.5% midpoint, because we're saying, hello, Governor, you have got room up to 6%. Please be comfortable there, but discussion for another day. I wanted to know about volumes, because they say that's one sign that your market is beginning to stabilize, isn't it? Or find the bottom. What have the volumes been like within the bonds market?
Yeah, they've been a little reduced. I mean, yesterday looked like it was 20 billion, which is really low. Of course, it's a Monday. Today being auction day, you'll see higher volume going through. But volumes, once again, going to that marginal buying, there's just limited activity really. And we're seeing, because of that lower volume, lower liquidity, these aggressive moves either way, and it's almost rewarding investors to do as little as possible at this point, because we've got some big risk events coming up as well.
Those risk events, including, of course, tomorrow. We have got CPI coming up, the governor again speaking, saying, suggesting that perhaps we are within the peak of that inflation spike. The ABSA view,
The ABSA view, I can tell you the ABSA Capital Research calling tomorrow in at 7.4, lower than what seems to be a consensus of the economists looking at it to be flat at 7.6. Would suggest to you there's a bit of risk it comes in lower, supporting what the governor's saying, that it's peaked. And then we've got to watch how it behaves from here. But if you look at, so headline inflation is one thing, but core inflation is expected actually to pop a little bit higher tomorrow. Right. But remember, that's in the 4s. So core inflation that excludes food and energy is under control. So, there's going to be a lot of interest in tomorrow's number to give us a feel for what's going to happen in November.
What potentially would make a difference for that last MPC meeting of the year in your view? Or is this a number that you think the market will look at and the market will not draw any big conclusions in terms of what might happen when the governor and his team meets?
Yeah, I think so. So we'll have another inflation number before the next MPC.
Yes.
So this one I think is less important because we've also got the Fed meeting coming up, and again, so they'll have a November and they'll have a December meeting. So in the back of your mind, it's probably still more about the currency and keeping lockstep with the Fed at this point. And we know at the moment it looks like the Fed, given what's happened to their inflation, is going to go another 75 potentially. So I think the SARB seems at the moment to want to just keep this volatile global movement of cash under control, keep things as stable as possible, and look after the rand as much as they can because they know inflation's peaked. So, also at a point they're going to want to slow down on the hikes, but perhaps just keep the hymn book as they have been for some time.
Yeah, and it's been humming along very, very nicely indeed.
Yes.
What's the ABSA view on the Fed? How big is the risk for that jumbo 100 basis point hike?
Yeah, I would think at the moment there's not enough reason to go with a jumbo 100. Also, once again, because they've got a November and a December and a January meeting. So they've got enough time to assess what's going on. Of course, their inflation a little bit higher than that, but I think they can keep things to 75 at this point. Their biggest challenge at the moment is making the market think that they've pivoted, that they're slowing down now on the hikes, and that's where you get asset volatility. So they don't want to unwind what they've done so far by signaling that they're starting to slow down too or prematurely. So I think they're going to keep going with the 75s, give themselves a little optionality.
Absolutely. Let's come back home and talk about Enoch. He's coming on the 26th. What are you guys looking forward to? I wanted your thoughts, first of all, in terms of the overall balance of the budget, and then secondly, in terms of issuance.
Yeah, that's the important one for us as bond investors. But it feels like the MTBPS is going to be quite good. There's good tax receipts. It looks like we could return to a primary surplus sooner than expected. But then you're going to have spending pressures like flood reparations, perhaps making the COVID payments more permanent, talk of income grants as well. But it feels like we're moving in the right direction. So I think overall, especially with high cash balances, they'll be in a more comfortable position, but they're going to be conservative. With regards to issuance, it feels like they've got space to reduce issuance. They've had successful floating rate bond auctions, which has taken some pressure off, given them some cheaper funding as well. So they could reduce issuance. I don't know where we stand on this at the moment, but you might think, given the risks going into year end, given in the back of your mind even this FATF grey listing story and the uncertainty around that, maybe you don't want to reduce issuance, maybe keep that card up your sleeve to play it at a later point. We're still seeing today's auction went fairly well, considering bond price action has been negative thanks to global changes today in the UK. So I think, there's space for them to reduce. Should they do it? Well, the coin's in the air on that one. Maybe they'll play it out until the actual budget.
I just want to follow up very quickly on grey listing. Does that pose a risk to the hot money side, which of course is where we see the daily action?
There's a few risks. Of course, the immediate response would be negative to that. But I think the bond market is broadly pricing in a fait accompli that we will be grey listed.
Sure. The minister yesterday was saying, no, we will not be grey listed. Peter and his research says 80% chance. I don't know who to believe.
It's a tough one to make a call on. But if you look at the stats as they stand and the tick boxes that are required, there are many outstanding that are incomplete in the view of FATF. So at this point, it does feel like it's going to happen.
Sure.
Then you've got to look at, well, what does that mean for bond markets? Initially, it doesn't mean too much. What it does mean for something for is multilateral funding down the line, perhaps ESG mandates and that sort of thing that might move away, and just the reputational damage that has 100%. In general. So it's not a good development. And I think the uncertainty is how the market actually reacts to that. But remember, we're out of investment grade as well at the moment. So it's going to not be, it's not a good development generally. But I don't think it has a sudden knee-jerk reaction like a downgrade to non-investment grade. That's out of the way, of course. But it is something definitely that it will be a concern for the longer-term prospects.
Yeah, and we're talking, of course, about January, March next year. I think that's when that decision is going to be made.
That's it.
Okay. Before you go, I've got to ask you, of course, about what the guys at RMB call the rattlesnake.
Yes.
The rand, right?
Yeah.
Is 18 the new normal? I mean, we had gotten used to 17, and then now it sounds like every day you call the rand, you have to say 18 something.
Yeah, we often say, it's kind of, if you're a South African investor, all your assets are exposed to currency, so it's always good to diversify where you can and buy some offshore. But over a longer period of time, it's determined by interest rate differentials.
Right.
Where we are at the moment, though, we're responding to a stronger dollar globally. And that makes it difficult to fundamentally try and make an analysis of where fair value is. It's so difficult. The feeling at the moment is the rand's going to be under pressure until the US hiking cycle changes. Because they've got strong growth, strong employment, and they're hiking rates, that suits the US dollar and not so good for emerging markets. That'll change at a point, and the rand probably does settle below 18. That would make sense. Historically, it overreacts and comes back. But for the time being, volatility's there, and the rattlesnake name remains.
It absolutely does. You're taking me back to 2001. I think it got to, was it 13.70 or something thereabouts?
And quickly.
And ran all the way back to 6 or 6.5 or thereabouts.
Like an error on your charts when you looked at it. That was a very brief move, but a painful one.
Absolutely. Let's hope history repeats itself. James,
thank you, Godfrey.
James Turp is our head of fixed income at ABSA Asset Management.